to those types of conversations, you can do so through a lender that participates with the San Diego Housing Commission or a loan officer from the company that I represent. So once again, my name is Sergio, and I'm part of Citibank. And what I do for the bank is I help drive our home ownership opportunities for low to moderate income families and individuals. So we work with diverse real estate groups. We work with a lot of nonprofit organizations, and of course, with housing authorities such as the San Diego Housing Commission to provide educational workshops, to expose some of our specialized programs, and to just talk about homeownership in general. So once again, this webinar is really meant to provide an educational focus. So don't think that this is a selling plug. You're not going to subscribe to a membership at the end of our webinar. So once again, we would like to thank the San Diego Housing Commission, Juanita and her team, Stephanie, and just for all their great support, and for them to set up these types of events. So definitely reach out to the San Diego Housing Commission if you're interested in more type of financial topics, any type of resources that you would feel would assist you. Juanita is your go-to person there. So a little bit about our objectives. Once again, we'll talk about the general process of home buying. We'll determine affordability, which is perhaps the most important piece in this process. We'll talk about some of the basic mortgage terminology, the application process. We'll talk about loan options and the pre-approval process, and we'll end with some of the specialized programs that are available for you as a first-time home buyer. So, oh, by the way, guys, the chat is available for you. So you can write your questions out. Juanita will keep a close eye on that chat, so that if there's anything that we don't cover, we can circle back to your question. So feel free to write down your questions in the chat. And at the end, we normally do reserve enough time to go over those questions. So just enjoy the ride, and feel free to think about some of your questions. So in general, guys, the steps towards home ownership, there's not a particular predetermined way. Everyone typically starts the home buying process slightly different, right? So but in general, what you want to do is really research your local housing market. And then what we want to talk about this is to really understand what your needs are, understand what your affordability is. And when we say research your local housing market, really come to an understanding of needs and wants. So at times we may have a preconceived notion of the type of property that we would be very willing to purchase, right? But perhaps that type of property, it's outside of our affordability. So in that regards, we would want to just basically understand, right, what our options are, from our best option to our second best to our third best. Sometimes those options include, perhaps a property that's further away from your place of work, where potentially you're going to have a little bit more time on the road, right? So transportation needs could come into a play. So that's what I mean, right? You definitely want to research your local housing market, and really know who the true professionals are. When you're doing your research, this is a time when you can really begin to play the what if game, right? What if I do this? What if I do, this option? What if I decide to purchase with a family member, right? So all those types of different scenarios is where you want to explore now, because now you're not under any pressure. You're not under any contract. So it's a lot easier to have those conversations. Discuss options with a mortgage representative or a housing counselor. I mentioned previously that we support a lot of housing counseling organizations. Housing counselors are perhaps the best kept secret in home buying. They can analyze your financials to determine affordability and to determine what some of those options you have to purchase a home. If you do decide to move the process forward, that's where a pre-approval, and of course, I'll talk a little bit more about what that means. But a pre-approval essentially is your golden ticket to start to look at homes in specific price ranges that match your criteria, your search criteria. And in general, when you find a home, you would submit an offer. At this time, you may hear that the market is very competitive. That's because there's less inventory, there's less houses available in the market. So the buyers, such as yourselves, are competing a lot more for a lot less inventory. So essentially, the supply and demand, you may have heard those terms before. There's a lot more demand than supply, which of course creates competition among buyers. Once your offer is accepted, that's where, with the help of a real estate agent, you will be able to negotiate and sign a sales contract. That's where you would complete the mortgage application with a loan officer, a mortgage broker. There are certain home inspections that have to be done as recommendations for the buyer. Some inspections are really not mandatory, but are highly recommended for buyers. You would negotiate any potential repairs on the property. You would complete a final walkthrough, and of course, close on your mortgage. Now, I went through these steps as if you were buying a cell phone, right? This is actually a detailed process. It could take anywhere from 30 to 90 days, depending on certain situations. So as you can see, this is a general overview, but easily we can spend an hour just on submitting an offer. We can easily spend 2 hours just on negotiating and your sales contract. So these talking points are, in this particular webinar, it's just to give you a brief overview, but know that there's a lot more detail within our talking points. So pre-approval, essentially, if you start the process of looking at homes, you want to know exactly what you're getting yourself into. And what I mean by that is a pre-approval is when you sit down with a lender, whether it's a mortgage broker, a loan officer, and you verify three main things. You verify your income, you verify your assets, and you verify your credit. With those three things, a lender is able to determine your affordability, your monthly mortgage payment, how much down payment you're going to need, and any potential programs that you may be eligible for. The reason why this is important is that the affordability piece will let you know from the start how much of a house you, one, can afford, and two, you can pay. What I mean by that is you can afford a certain amount, but can you really pay that certain amount every month? That's where every person is going to be a little different, right? There's certain parameters that are that take part of your financial household budget that may not be included in the affordability piece from a lender's perspective. So this is why this is very important, obviously, because at the end of the day, you're the one that will be making that housing payment. So, this is just a quick plug here is that, most times, banks and certain lenders do not charge for pre-approvals. And typically that pre-approval letter is valid for up to 120 days. So what that means is if within 120 days you haven't entered into a purchase contract, then the pre-approval cycle will just have to reignite again. So before you look at homes, right? Before you start, you jump on on your car and you start looking at homes. You really want to know how much you can afford. I can't stress this enough. You want to understand what your purchasing muscle is. You want to know how much you can afford. Um, you want to determine how much cash you have for down payment. Although there are phenomenal programs out there that provide down payment assistance, you as a first time home buyer will still need to bring money to the table. So I'll circle back to this, but know that there are phenomenal programs out there that can help you bridge that gap of affordability. You may be eligible for certain down payment assistance programs, but know that there's always a little bit of money that has to come from your own pocket. There are some exceptions to the rule, but in general, you have to bring money to the table. You have to have what we call skin in the game, right? Calculate your monthly income and expenses. Another thing, can't stress enough how important it is for you to have a household budget. By a show of hands, how many people right now have a household budget? I'm kidding, I can't see you all, but this is very important. This is extremely important because even as you prepare for home ownership, a household budget is important. How important do you think it is? How important do you think a household budget will be to be able to sustain home ownership? It's even more important. So, uh, practicing positive financial habits, such as having a household monthly budget, which is your income and expenses, is extremely important. There you begin to identify spending leaks. Spending leaks can help you save more. So once you fix those spending leaks, once you identify where your spending leaks are, you can quickly react. So instead of having those leaks, you can have that as savings. Now, if I can have you guys put yourselves on mute just so that other participants are able to listen in. So estimate your monthly mortgage payments. This is an easy way to just estimate how comfortable you feel with the potential mortgage payment. So it's kind of like a play in practice, right? So if your current rent payment right now is $1,200, $1,200, and you feel that you can afford a mortgage payment at $1,500, $1,500, right? Just pretend that is your mortgage payment. Every first of the month, instead of paying your landlord the extra $300, just put that into your savings. If you can continue to make that extra payment every month, then you're looking really good, right? Because you're estimating how much of a mortgage payment you can make. If every month you need to take those $300 and put it back into your checking account to pay bills, then potentially we have to revisit this, right? So just things that you can consider, and then of course determining the property that you might be interested in. Obviously, we may have, like I said, a perception of the perfect property for us: 3 bedroom, 2 car garage, white picket fence, right, with a yard to have 2 dogs. But essentially, we may be starting off slightly different. We may have to consider a townhome or a condominium just because of our financial position, which provides us a different affordability option. There are several options, even as a first-time home buyer. So just know that these are potential alternatives that you could consider if your first and foremost option is it doesn't come through. So once again, you may want to live in the vicinity where you live now, but home prices may be slightly higher. So you may consider perhaps buying a home further out and commuting to work, with a little more time of commuting versus staying within the vicinity where you live now. So once again, those are talking points that it's great to discuss now prior to getting into a purchase contract. So I mentioned a little bit about the down payment requirements, there's also closing costs associated when you purchase a home. Um, this can vary slightly from lender to lender, so I'm not gonna spend too much time on this. This comes very important when you're doing your pre-approval, because then you start to compare options, right? But know that there are certain fees that are part of the process, and potentially are fees. You know, in business, you may call these like sunk costs, where, for instance, an appraisal is a fee that's not paid to the bank, it's not paid to the lender, it's paid to a third party. It's required because the bank needs to assure a certain amount of value compared to what you're purchasing the house for. The reason for that is your loan program has parameters that have to fit the appraised value and what you're purchasing the house for. If the appraised value comes in below what you thought the value of the home was, then potentially the bank may say, you know, I can't lend on this property because I'm going to have to lower your affordability because the value is less than what we thought it was. So in that particular situation, you may decide to cancel the contract, but you're not necessarily going to get your money back on that appraisal. So I know that that was a long-winded example, but you know, some fees, like I said, are just fees that are part of the process. And that's where working with a housing counselor, working with a true professional, a real estate agent, um, they will guide you and walk you through this process so that those types of situations, you know, are not, you don't have to go through those types of situations. So loan related costs, you know, typically there is an application fee, home inspection fee, that's a fee that you pay to a third party. The appraisal fee, it's a third party fee. The credit fee is paid to the lender, and discount points is typically part of when you are looking at rates. How much of a cost is that rate? How much are you going to pay for that particular rate? Rates fluctuate on a daily basis. In fact, they change frequently during the day as well. Um, so at any given time, the rate has a particular cost. So if you wanted to lower that particular rate, that's where you would potentially pay discount points. Like I said, some of these uh, concepts may not be apparent right now, but when you're in the process, you would actually have a lengthy conversation with your loan officer to talk and to talk about discount points and whether or not that's an option you would want to consider. Other types of costs and fees that you may be subject to: legal fees. Only in certain states. In the state of California, we typically don't have legal fees. Title search charges, recording fee, transfers fees, those are typically local municipality fees or local government fees. Escrow impounds refers to the account that's going to hold your tax payment and your homeowner's insurance, which I'll talk about in just a little bit more. And settlement fees are referred to the fees that you essentially pay as part of the closing process. So think about it as when you purchase a car or you lease a car, there's some extra fees that you're paying, such as the dealer fee or the DM fee, registration fee, right? Um, those are like third party fees. Well, similar fees are part of when you're buying a house. So what lenders look at, right? So these are perhaps the main five buckets. There's other things that lenders look at, but if we could just narrow it down to five things that a lender looks at to consider a mortgage loan, an approved mortgage loan, these are it. These are it. So first and foremost, let's go with your employment and income history. Why is that so important? Is because the lenders have to determine your ability to repay back the loan. back in 2008, at the height of the foreclosure crisis, a year later, there was an act that came about, the Dodd-Frank Act, that enabled lenders to make sure that when borrowers are obtaining mortgage loans, they're qualified for that particular mortgage. And a lot has to do with your income. Your income just determines your capacity, right? Previously to this, there was a lot of loans, believe it or not, that didn't verify income. So imagine that as a first-time home buyer, and the bank not needing to verify your income, right? So all that has changed. So know that income is very important, and it has to be verified, and it's verified on multiple levels. Your credit history, well, why that is so important is because that allows the bank or the lender to see your previous performance with other debts. How does this borrower manage financial obligations? So your credit history is very important. There's two things that we look for in your credit: your score, right? The middle of the three scores, there's three bureaus that report to, three major credit bureaus that report to the three major credit bureaus that we obtain to get your credit report. That's Equifax, TransUnion, and Experian. So the score is very important. The middle score of those three credit bureaus is what the lender takes as your score, and the content. So whatever financial obligations you may have are looked at.
You're freezing
Can you
up a
hear
little
me?
bit, Sergio. Yeah, you're freezing up a little bit.
Yeah, let me check this real quick. Hopefully, is this better?
Yeah.
Hopefully, is this better?
Yeah.
Okay. Okay, thank you. I have my hotspot connected, I guess, too far away. So let me know if for some reason we get spotty again. So I talked about income, I talked about credit. The appraisal, once again, that's really important because whatever you're purchasing a house for, the value has to be there as well. So it's really important for the two to it's really important for the two to be looked at, because every program has parameters that are called loan to value. So the appraisal has to come in at a certain value based on what you're buying the house for. Assets, very important, because every program has a minimum amount of down payment. Like I said, even though you may be eligible for specialized down payment assistance programs, there's still assets that are required from you to have or to bring to the transaction. And of course, debts, why your obligations are important is because your debts affect your affordability. If you currently have obligations, you're going to have those obligations even after you purchase your home. So it's important to know what debts you have now and how they will impact your affordability going into home ownership. Juanita, is it better, or is it still pretty spotty?
It's better, but we do have a question regarding the previous slide. And it's
Sure.
saying, I heard that right now some houses are not getting appraised because of pandemic. Is that true?
Juanita, I'm sorry, can you repeat the question?
It says, I heard that right now some houses are not getting appraised because of the pandemic. Is that
Oh,
true?
okay. So I let me know. I understand that question's on two different ways. Initially, when COVID started back in March, I should say when the stay-at-home order started due to COVID back in March, the owner of the house did not want other people coming in. So that's one way. The appraisals were taking a lot longer because once again, if I was the owner of the house and I was selling my house, I had a hard time letting someone in to do the appraisal. Um, Now, the second way I understand that question is because of competition from buyers, right? Um, if the price of a home, the listing price of a home, and I'm going to make up some numbers, is $400,000, but you had multiple buyers, essentially that's going to raise the listing price, or I should say that's going to raise the price that the offers are being submitted because the buyers want to be more competitive. The buyers are competing with other buyers, so they want to beat out those other buyers. So if the house was listed for $400,000, buyer A won that negotiation and offered 450 for that house, right? That seller was really happy. But the appraisal, it's not going to look at those offers. The appraiser is going to look at previous homes that have sold within the 3 to 4 months. And if those values do not support a $450,000 value, then the appraisal might come in at 400,000, 405, maybe 395. So I'm not sure how that question was being asked, but that's how I understood it, right? In those two different concepts. But at this time, there's a lot of appraisals that are coming in below what the buyers are offering to buy that house. And how that impacts the buyer is that if you were pre-approved for $400,000 based on an appraisal of $400,000, if that appraisal is now less, then that loan amount is less that you're going to be approved for. Essentially, either you're going to come up with the difference or you're going to negotiate that difference between you and the seller. So once again, that's a great conversation, and typically, we could elaborate a lot more on this talking point. So good, good.
So we are having appraisals conducted right now, even with the pandemic.
Yes, yes, we are.
Perfect. Thank you.
Fantastic. So a little bit about your credit history. Like I said, I know the Achievement Academy provides guidance and support. If you are someone that would want to review your credit and see how you can improve your credit, that's a service that is provided. But in general, these are some of the categories that lenders evaluate to determine your credit behavior, right? So your timeliness of payments, really important, specifically the last 24 months, how you've paid on time within the past 24 months has a heavier weight than payments you made over 24 months. So let me just give you a quick example. If Sergio made a late payment on his car 2 months ago, if I made my car payment late 2 months ago, then that's going to have a heavier burden than me making a late car payment 3 years ago, right? The past 24 months are significant to the weight on my score. So anything that's past 24 months doesn't have the same amount of weight than anything within the 24 months. So if you're current on if you have a on-time payment history within the past 24 months, that's very good. That's very good. Anything after 24 months, it may not affect you as much. So just know that the past 24 months timeliness of payments is extremely important. New inquiries affects your score, not very significantly, but a lender might wonder why you have inquiries, right? So if you're going through the mortgage process, you shouldn't be considering to buy a car. You shouldn't be considering to buy a TV from Best Buy. Nothing wrong with a TV from Best Buy, don't get me wrong. But if you're going through the mortgage process, you do not want to be shopping for other big items. Past credit problems, more importantly, how you solve those past credit problems. It's okay to have things in the past, but the lender's going to want you to explain what happened, but more importantly, what you did, right? If you had, say, medical collections, although medical collections are not taken into account very much, but just, hey, can you explain why you had a medical collection? Well, there was an insurance issue. They couldn't take care of it. My co-payment was actually a lot more. So I ended up with an extra debt, which I paid off in 6 months, right? That's a letter of explanation, done deal. Types of credit, right? The diversity of your credit types help the overall credit report. If you only have, say, credit cards, right? Although that may be okay, but if you have like a credit card and an auto loan, those are different types of trade lines. One's an open trade line, or revolving trade line, I should say, a credit card, and a auto loan is a term loan when you have a start and a finish. Credit amounts and utilization of credit can go hand in hand. Definitely be on the safe side and know that a rule of thumb on all your credit cards is to not maximize them, but to be at or below 30% of usage. So what I mean by that is, if you have a limit on your credit card for $1,000, you never want to go past $300. That's 30% of that limit. Well, why would you have a credit card for $1,000 and only be able to use $300? Well, this is part of the credit matrix, right? So the lower utilization percentage, the better the score. So if you use less credit on your credit card, always maintain that lower balance. It'll help you in the long run. So just once again, just in general overview on credit. Application checklist, I can touch on a couple things. Know that things get verified on multiple occasions, such as your employment. You got to be prepared. You got to be organized to have all your tax records, pay stubs, social security ID cards, rental agreements. So know that a lender is going to require a complete application, asset documentation, bank statements, identification cards, your liabilities, of course, that's obtained through a credit report, and basically any other type of documentation based on your particular situation. At times, you may be a co-signer on, say, a family member's auto loan. If you're not making that payment, you're going to need to provide proof that you're not making that payment and that other person is. So that's an example of other documentation. I will, talk about exactly what's included in your housing payment, because I think this is really important. If you currently rent right now, your amount of rent is your housing payment. When you're a homeowner, that housing payment has a couple of layers. So the first two layers are truly the mortgage payment. Your principal and interest is truly your mortgage payment. So in your complete housing payment, your mortgage is included. That's the first layer, which is your principal and interest. As a homeowner, you now own the dirt, right, of where the property sits. Well, you're going to pay property taxes. Property taxes are based off the assessed value from the first year of purchase. So as a homeowner, you're going to have a property tax payment. Now, property taxes are due every 6 months. A lender typically takes a portion of your tax payments, so that every month you're adding to that tax bill, so that when your tax bill is due, the lender has enough money saved to pay your taxes. Your insurance is due once a year. Same thing. Every month, the lender is going to require a small portion that contributes to that insurance bill, so that when your insurance bill comes in, you have enough. Well, that enough sits inside an escrow account, and that's required by most banks. You can waive the escrow account if you purchase a house with 20% down payment or more. If you don't put down 20%, or if you put down 20% or less, then the bank's going to require that escrow account, and that's just to make sure that the homeowner will have enough funds to make their property taxes and insurance payment. A couple of other, some of the other layers that are part of your housing payment: homeowners insurance rights, part of the insurance. Um, hazard insurance protects the structure. Homeowners insurance protects your assets. So it's slightly different, but as a homeowner, you now have a big asset, right? A property that's valuable. So you want to also be protective of your of liability, right? So in case someone comes to your house, they trip and fall, and they break their arm, right? Your insurance covers that. Private mortgage insurance, this refers to certain programs that require this extra layer of payment based on the fact that if you're not putting down 20% of the purchase price, the mortgage program could add this extra layer of payment. There are programs out there that do not have private mortgage insurance, but you want to be mindful that certain programs do. You may have heard of FHA. FHA is a great, phenomenal program, has helped many families achieve homeownership. FHA has private mortgage insurance, and it's on there for the life of the loan. Flood insurance, it's only applicable if the property sits in a flood designated zone, which is designated by FEMA based on topography measures of land surveys. So, you know, not every property is going to have flood insurance, but if the property does require flood insurance, it's a little hefty in the price. So you know, that's one of the things that you might be concerned about when you're in the position to look at houses. You might want to say things like, hey, is this house or this property required to have flood insurance? Because if it is, I'd rather look at other properties, right? Um, homeowners insurance, homeowners association dues is applicable for condominiums and townhomes and for properties that have common areas such as a clubhouse or a pool, a community pool that is shared by the specific community. So know that as a homeowner, your complete housing payment could include several layers of payment, right? I'll give you an example. If you're buying a condominium using FHA financing, your total housing payment will include your principal, your interest, your property taxes, your homeowner's insurance, your HOA, plus your PMI. If you're buying a single family residence outside of an association, you're paying principal, interest, taxes, and insurance. So once again, everyone's going to have a slightly different variation of what's included in their housing payment, but just know that as a homeowner, not only are you paying back the debt, right, which is the money you borrowed, which is your mortgage, it also includes other layers. Not to scare you guys. This is not to scare you, by the way, guys. This is, once again, understand, because this is part of your affordability. So real quick about how lenders determine what you can afford. Every program has certain ratios that they have to abide by. So think about it this way. If your current income is $5,000 a month and your housing payment, what we just went over, what we just went over is $2,500 a month, that means that 50% of your income is tied to your housing payment. That's an example of a housing ratio. 50% housing ratio is extremely high. Imagine that, 50% of your income tied to your housing payment, that's extremely high. So every program has different ratios. The lower the ratios, the better, right? The lower the ratios, the more affordability. The higher the ratios, the more risk. So if there's more risk, it might come at a higher cost, meaning a higher mortgage rate. I know we're running out of time here, so I'll just talk just a little bit about facts about mortgages, and then we'll open it up for Q&A. Understanding your mortgage, the larger your down payment, right, the less the mortgage payment. It's just proportional, right? The more money down you have, the lesser amount you're going to borrow. A loan with 20%, a loan with less than 20% of the purchase price may require private mortgage insurance. So that's that extra layer of payment that's included in your housing payment. Once again, there are programs, there are specialized programs that do not require private mortgage insurance. So essentially, it's a more affordable program. Your home in the state of California serves as collateral for the mortgage until it's paid off. So similar to a car loan, the car is collateral for that auto loan. The house is collateral for that mortgage. The interest rate, along with the term and amount of the loan, determines the monthly principal and interest payment. There's always a questions about where the rates are. If you can Google, mortgage rates, you'll see a good, perception as to where rates are. Just know that rates are extremely low right now. But to provide more content, right? Well, when is the right time to buy, right? Is right now a good time to buy? It depends who you ask. If I was a real estate agent, I would say yes, absolutely. Let's go out and look at houses today. Wearing a housing counselor hat, I would say, well, let's look at your household budget, right? Because your household budget will paint the picture of your affordability map to determine if you're ready or not. The final piece to that is ask yourself, hey, am I ready? There's other factors that are not financial factors that are very important to determine if you're ready to buy a home. Oftentimes, we tend to focus on things such as the market values, the mortgage interest rates, but we forget about things such as where we want to be in 3 to 5 years. Currently in my place of employment, what if I'm being offered a position out of state, or let's just say I live in San Diego, I might consider move to Riverside. So should I buy a house here in San Diego or Riverside? I mean, those are big questions, and oftentimes those questions are not answered by a industry professional. Those questions are answered by the homeowner and their household. So some terms to know, just real quick, the APR is really a term that measures not only the interest rate, but the cost to obtain that rate. When you're looking at two comparisons, the APR will give you a sense as to what option is costing you more. A variable interest rate is essentially a rate that fluctuates, and it's not fixed. So essentially, you could have a mortgage with a fluctuating interest rate. So your payment can either go up or go down. At this time, of course, it's not a valuable option. Most people choose the fixed rate option, once again, because of the low interest rate environments. So I'll just jump ahead here and end the pause for a second and open it up for Q&A. I want to make sure that we answer questions that you may have.
Thank you, Sergio. That's wonderful. I know we ran out of time. I know you've got so much information and it doesn't fit in just 1 hour workshop. But one of the questions was if private insurance is like a balloon type payment.
So repeat that again. I'm sorry.
Private mortgage insurance,
Yeah.
is that like a balloon type payment?
No. So private mortgage insurance is essentially an extra layer of paying. It's an extra insurance that doesn't go to pay down the mortgage. It goes to an insurance company, really, to protect the investment. So why is there private mortgage insurance? It's because essentially you're borrowing almost as much as what the property is worth. So from the investor, not just the bank, but the investor who's providing those funds, they look at that as a little bit risky. Contrary to someone who put down a large down payment, right? the value is here, the loan amount's down here, well, there's less risk, so we don't need that extra layer of insurance. Like I said, there are some programs out there, specifically community lending programs, that do not have private mortgage insurance, even though the value is here and you're borrowing here. So just know that there are options available.
So this is a twofold question.
Yeah.
What if I want to buy with my brother? And two, what if I'm not divorced yet?
Okay, so I'll answer the first one. If I want to buy with my brother, when you buy with someone else, is as if you're buying with a significant other, a spouse, mom, dad, sister, brother, aunt, or uncle. From the lender's eyes, they're both borrowers. So both borrowers need to come in with individual parameters. So if the program says minimum FICO score is this, both borrowers need to have that minimum FICO. If the program says verification of employment for X amount of time, depending on the situation, if you're using income from both borrowers need to have that minimum time of employment to count that income in that loan application. So at times it makes sense to include someone else, but you also have to consider, will that someone else really contribute to the mortgage payment? So once again, that's essentially, yeah, if you're including two people, you have two incomes now versus one, you're going to have a stronger application. But once you buy the house, who's really going to pay the mortgage? Is it going to be two people, or is it only going to be one? So once again, those are conversations to have as to the why we're doing things the way we are. I'm sorry, what was the second part, Juanita? I'm sorry, I lost track.
What if I'm still married?
Okay, so if you're married, and if you want to buy a house by yourself, so here I'll expand. So if like, I'll give you my example, for instance, right? Or I'll put myself in an example. So I'm married, and if I want to buy a house, some programs do require to know my significant other's financial state, because if my significant other has other mortgages and we do our taxes together, right, then potentially I'm tied to those mortgages. So the lender's going to want to know, hey, what's going on over there, right? If I'm doing it because potentially I'm looking ahead and there might be a division or a separation, if I buy the house, and this is not legal advice by the way, but if I buy the house in the state of California, we're community property, let alone if you buy the house during the time you were married, then that person may have rightfully right to that asset. So I'm not sure if that question was intended, or that part was intended for the question, but essentially, yeah, you can buy a house by yourself, even though you're married, but your spouse will still be rightfully have a vested interest in that property, even though he or she may not be on the mortgage, because of state, California is a community state property.
Wow. Okay. So it says, is there an expectation that the market will be impacted significantly in the next 6 to 12 months due to COVID?
Wow, that's a very good question, and I'm sorry, I want to say, I mean, just being frank, I don't know, and here's why. We have, as many of you know, November 4th, I believe November 4th, November 3rd, right? The elections, so that is one thing. We're not quite, we're never sure during an election year the ramifications in the economy. Two, the pandemic is still not, completely, although, certain cities, right, we're a lot more freely now, but we still don't know. There might be another twist and turn down the road. So that the uncertainty is there. The final component to this is inventory. California has a shortage of housing. And if you are interested, you can just Google, some of the cities that are really struggling with housing. Chula Vista, San Diego. There's a lot more, not just buyers, but people that are living with family and because of the lack of housing. So just that in itself, it seems like we're going to be in this type of situation where there's a lot more demand for housing than supply. So when there's a lot more demand, the values tend to hold on because the demand is there. When it's flipped around, like in 2008, there was a lot more inventory than demand. That's when the values kind of went down. But like I said, I'm sorry, I can't provide a more, a directional or crystal ball type of answer, just because there's so many variables right now. Even economists, recently heard that, they're focusing on the uncertainties, but they're really they're giving option A could be this, option B could be this, and option C and D.
So then we have another question on marriage. And it says, if someone is married and they haven't gone through a divorce, but are ready to buy a house, what can be done?
So I guess I'm reading between the lines is that we're married, but we haven't divorced, but essentially we may be separated. Like I said, that's more of a legal question. I mean, from what I know, as we could be separated for a few years now, but if we're not legally divorced, the community property here in California gives that other spouse, a legal right to that property. There are some exceptions, such as like health issues or things like that, but that would be more of a legal type of question. And I'm sorry, once again, I may not be the right person to answer that, but just in general, the state of California is a community state property. So even if I buy a house and I don't tell my wife about it, right? I want to be sneaky about it. He or she, has the legal right to the property.
So we have one more, and it's saying, and this is, I don't know where this came from, but it says, can a single person get a $500,000 plus loan with great income? I heard you could not do that.
Oh, okay. So, you know what? This is a good question because it's tied to fair lending, and let me just reassure everyone that being single, the type of income that I have, the sources of income, my age, my ethnicity, my race, my gender, my sexual orientation, all that does not play a role in the decision of a mortgage loan. What plays a role, and I think we kind of covered those buckets, right? My income, my employment, my assets, my credit, my debts. So if I'm single, if I'm a single parent, if I'm a minority, and of course I can expand on this, but under fair lending, that does not take a seat to determine whether or not that person is able to get a loan. So if I'm a single person, if I have the income, I have the credit, I have the assets, yes, I may be eligible to get a loan up to 500,000, even higher. It's based on my financial circumstances.
Perfect. I don't see any. Oh, wait. Is it true that you can put down $1,000 of down payment for a home in San Diego?
So there's certain programs. I think I know I mentioned a little bit of down payment assistance, or so I'll just give you a real real quick, because I know we're coming up to the top of the hour. The VA program, the VA, the Veteran Administration Program. So anyone that's a veteran of our armed forces here in the US, first of all, thank you for serving. You may be eligible for the VA program. The VA program is absolutely 100% financing. So you may not even have to bring to the table $1,000. That's one exception. There's other programs that, yes, help with the down payment, but you have to have a certain amount as well. So that's where there'll be variations of those programs. Any type of program that has down payment is tied to a specific income requirement, meaning that not everyone's going to qualify. So every program has different incomes. Unfortunately, there's, they don't make this easy, right? So the city of Chula Vista is going to have different incomes than the city of San Diego, than the city of National City, and funds are cyclical. So city of San Diego may have money, but now city of Chula Vista is out of money, and now National City has money, but wait, Oceanside is out of money, and not every city or municipality has funds to fund these programs. So knowing that, your income is on a sliding scale. So depending on your household size will depend on the level of income that you can have. Once again, in this type of setting, it will be real difficult to go over every single down payment assistance program parameter. But you can actually go into the San Diego Housing Commission's website to learn more about the city and the county's program. Phenomenal program, up to 17% of down payment assistance, of which, once again, 3% has to come from your own pocket. So yes, there are certain situations where a borrower, does or is able to purchase a home with very little down, even up to $1,000. Those are few far in between, but know that, even with down payment assistance, you have to have some money, some money in the bank. You have to do your research, just like running a marathon, right? You have to have that financial fitness. You have to have a household budget, tighten up those spending leaks so that you have that little bit of cushion. The good thing is that once you have that, you may not need all that. So once again, certain programs, when they overlap, you may have thought that you were going to have to come in with, say, $10,000, but at the very end, you only came in with $2,000. Depending on the programs, it all falls into place. So I know I'm generalizing, but maybe that's another future topic that we can just focus on, is just strictly down payment assistance. Juanita.
Thank you. So we are going over a little bit, and we just wanted to, there's one question about, can you get help to buy a home with cash aid plus SSI and minimum income as, and no, not good credit? I don't think that's possible, but you tell me. Sergio.
So the income is not an issue, but once again, the income sources is not an issue. As long as they're verifiable, it's qualified income. You said bad credit, that would be my only like red flag, right? Like, hey, tell me more. What do you mean? Or why would you say you have bad credit, right? So there would be the focus, and knowing what potential challenges we have, then you could start to work on an action plan. So that's where potentially, sitting down with Juanita would be is to first maybe pay down some of your debt, maybe reestablish some trade lines to increase your credit rating. So like I said, everyone's going to have a different starting point to buy a home. So that's where, housing counseling, San Diego Housing Commission can assist you to begin your action plan.
Well, perfect. Thank you, Sergio. That was wonderful. I appreciate the time you took out of your busy schedule to do this for us. And for all of you that are on the line still, just be aware of us coming later on. Sergio is going to be looking at bringing in some realtors next month that can tell us what the housing market is looking like at that point. That's going to be like the best of the workshops, and that's coming in November. We'll let you know. They're saying, well, they're asking one final question, and that's, can you buy a house with an ITIN number?
Certain lenders allow for that. Certain lenders allow for an ITIN number. So the short answer is yes, you can. Down payment assistance programs require US residency or US citizenship. So there wouldn't be options on the down payment type of programs, but there would be options on conventional types of programs.
Perfect. Thank you, Sergio. And thank
Thank you,
you all
Juanita.
for joining us. And I look forward to seeing you all next month for the one with the realtors that'll come in and talk about the housing market now during this COVID and give us some insight on what's going on there. Bye.
Absolutely. Thank you, Juanita. Thank you, everyone.
Bye, everyone. Thank you for coming.
Thank you so much.